which is payable to the preferred stockholder when? Quarterly or annually, by whom? The board of directors of the company, and it's guaranteed. This is an equity that has income attached to it. Are you with me so far? Yes. Created to compete with the interest income that bonds pay to keep money on the equity side. That's why preferred stock was created. That's where it gets its name from, and that if you buy it, you would have preference to receive those cash dividends paid to you prior to whom? Prior to the common stockholder. And so now, when we talk about the return on any investment, are you with me so far? Yes. The return on an option investment, the return on a bond investment, the return on a preferred stock investment. The words return mean and are expressed in proper trading on Wall Street as 7. The yield on the security. What's the language? The yield on the security is the return that the security pays to the investor. So look up. Look up. Where is the yield that's payable to the preferred stockholder? In what form? In the form of the cash dividends. So when I talk to you about the yield on a preferred, watch my language. Watch how I just edited that out. What is the yield on the preferred? Oh, that preferred yield is 8%. 8% cash dividend. Are you with me so far? Yes. Now, we needed some type of financial benchmark from which to tie and pay those cash dividends to the preferred stockholder on a per-share basis, of course. And that benchmark that we use in the market from which to tie and pay those cash dividends to the preferred stockholder is known as the stock's par value. The par value of one share of preferred stock, the words par value also mean face value, is the dollar amount of money of how much one share of preferred stock is worth. And how much is one share of preferred stock worth? $100. That is called the face value or the par value of the security, which is the dollar value of how much one share of preferred stock is worth. Are you with me so far? Yeah. It's rather expensive, wouldn't you say? Why? Because of those cash dividends that are attached and guaranteed to be paid to the preferred stockholder. That's why preferred stock is so expensive. Are you with me so far? Yes. This par value, this $100 per share, dollar value of how much one share preferred stock is worth, is the financial benchmark that we use from which to mathematically tie and pay those cash dividends to the preferred stockholder either quarterly or annually to the following financial expression. Client goes out, look up, stay real focused today, and buys a 9% preferred. I said he bought a 9% preferred. He invested in a preferred stock that pays him a 9% yield, that pays him a 9% cash dividend. Are you with me so far? Yes. That's what that language means. Take the yield on the preferred, which is the 9%, and multiply it times the benchmark that we use from which to tie and pay those cash dividends, which is the stock's par value, which is $100. And 9% times $100 means the client's going to get $9 per share. Are you with me so far? Why, if the client owned a round lot in the position, how much would he get quarterly if he bought a 9% preferred? Round lot, Monday, prerequisite, is 100 shares. If he bought the stock at a 9% yield and he owned 100 shares of preferred, it pays $9 per share, he's going to get $900. Am I right? If he owned 1,000 shares in a preferred position and he bought a 9% yield, he's going to get $9,000. Am I right? Go out and buy a 6% preferred. Watch my language today. 6% times the value for how much one share is worth, which is $100, means $6 per share. You with me so far? Yes. Times the number of shares that he owns in the preferred position is how much he's going to receive dollarly, either quarterly or annually. Am I right? Yes. Yes. Thank you very much. And so the whole game associated with preferred stocks is about these cash dividends. The yield on the preferred is the cash dividend. It's paid and tied to the stock's par value on a per share basis times however number of shares that the client is long in the stock position. Are you with me so far? Yes. Whole game associated with preferred. Two completely different types of equities. Still ownership in the company. One, potential capital gains and or potential capital losses in the fluctuation of stock pricing. Possible cash and or stock dividends, not guaranteed. And of course here the guarantee on preferred stock of those cash dividend distributions, which pays a guaranteed return to compete with the guaranteed interest income return that bonds pay, which is why it was created. Are you with me so far? Yes. Now I want to talk to you about, if you'll look up, different types of preferred stocks. Look, you already know what's going to happen. We didn't even get started here today. This thing is going to be out of control. It's off the hook. Are you with me? Yes. I am now moving away from the two different types of stocks. I'm still talking to you about preferred, and now I want to talk about different types of preferred stocks. And it's based upon certain features that are built into these different types of preferreds. Are you with me so far? Yes. And this is mostly a prerequisite for NASDAQ, so let's rock and roll, shall we? The first type of preferred stock, just listen to me, is called the cumulative preferred. In this type of preferred stock, if you buy it, It has an accumulating cash dividend clause or provision or feature built into this type of preferred stock that says the following. If when it comes time for the board of directors to pay those cash dividends to those cumulative preferred stockholders, are you with me so far?
Yes.
If the company pays you less than what they have declared, are you with me so far?
Yes.
And then all those cash dividends that are in arrears, which means past due and owing to you, because they paid you less than what they said they would pay, will accumulate, that's why it's called a cumulative preferred, and must be payable to you, the preferred stockholder, down the road at an undetermined point in time whenever the company reaches a sufficient level of profitability. Stop, time out. Now we got to talk about why this occurs. We just finished saying that if you buy preferred stock, these cash dividends are guaranteed to be paid to you. And I'm not saying they're not going to be paid. I just said they might not be paid to you in full in that quarter or in that year. This is about a timing issue. Are you with me so far? Now, why would that occur? Why, if you bought a stock that has a 6% preferred, that means $6 per year, and the company is going to pay it annually, and when it came time to the end of the year, they paid you 4% per share of the 6% that they have declared, then what percentage on a per share basis is in arrears to you? 2% or $2 per share. Why did that occur? Because when you read Chapter 22 in the body of your work, and I have very good news for you later on that area, because I know you saw fundamental analysis and 45 ratios, and you're not knowing what to act and react about. I got good news for you today. When I say I have good news for you, you should listen to me. We'll get to the good news later on. You might have seen, or you might not have seen, that it is only when the company is profitable, when the company has earnings, that those earnings are used to pay some of those cash dividends to preferred stockholders. So what if it comes time by the end of the year that the company doesn't have a sufficient level of profitability and earnings to be able to pay, in my example, that's 6% per share. They could pay you less. Are you with me so far? And so therefore, on a per share basis, for all those dividend distributions that are in arrears and past due and owing to you, they will accumulate until at an undetermined point in time, whenever the company becomes profitable, payable to you down the road on a per share basis. And so this is a when issue. And so I want to talk to you about a real life trade, actually what happened in the market about a cumulative preferred. Are you with me so far?
Yes.
You know that still to this day, America is fighting two wars on two fronts, Afghanistan and Iraq. Are you with me so far?
Yes.
We're fighting two wars on two fronts. In the Afghanese war, we lost 5 stealth bombers. Are you listening to me?
Yes.
You know what the manufacturing cost is for one stealth bomber? I'm going to tell you, $5.5 billion. How much it cost to build one stealth? The companies that build the stealth bombers are defense companies, like Lockheed and Boeing. So I want to tell you what the military did about a year and a half ago. They said to Lockheed and they said to Boeing, look, defense companies, we want you to entertain bidding for a new military contract, and we want to replace the 5 stealths that were lost in the Afghanese war. So we're throwing out there to you, in an open bidding war, a $25 billion military contract. One of you two companies are going to win that contract so you can build us 5 new stealths to replace our arsenal and what we lost in the Afghanese war. Are you with me so far?
Yes.
It looked like at the 11th hour, Boeing was going to win that bidding war. Are you with me so far?
Yes.
And guess what happened at the final hour? The federal government found Boeing guilty, this is true, of bid rigging the contract and awarded the contract to Lockheed. Are you with me so far?
Yes.
At the time that this was going on, stay focused and listen to me carefully. Investors bought a 7% Boeing cumulative preferred. Are you with me?
Yes.
It's $7 per share. Now, when it came time for Boeing to pay that dividend, are you with me so far?
Yes.
They didn't have the earnings to be able to pay the full 7%. I'm going to tell you why. Lockheed got the contract. You see, if Boeing would have won this contract, are you with me so far?
Yes.
Like Lockheed did? What would have it represented to Boeing financially? Well, they would have got $25 billion in gross revenue from the contract, minus the cost of operating and maintenance to build those stealths. That would have given them a certain amount of net profit and net income. And some of that net income and that net profit was going to be used to pay out that cash dividends to preferred stockholders. And so therefore that financial picture no longer existed because Lockheed got the contract. And so when it came time for Boeing to pay the 7% dividend, are you with me so far?
Yes.
They only paid 4%. What percentage on a per share basis is in arrears and past due and owing to you? 3% of $3 per share, because when it came time for the distribution, they didn't have a sufficient level of earnings to be able to make that payment. Are you with me so far? Yeah. Therefore, the cumulative preferred stock says that 3%, my example, must be payable to you down the road at an undetermined point in time whenever the company has a sufficient level of profitability. It's not that the 7% is not guaranteed. It just doesn't have to be paid in full in that quarter or in that year. Are you with me so far? And that's why Series 7 Bullet 1, the cumulative preferred stock, is the most popular type of preferred stock that's issued in industry than any other type of preferred stock. They're going to ask you, which type of preferred stock, all the types that we're discussing right now and going to, is the most popular and issued more often in industry, and that is the cumulative preferred. Now the question becomes, from whose perspective? What's so popular about this type of preferred stock? There's protection built in here somewhere that other types of preferred stocks do not have. Protection for whom? Is it to the preferred stockholder? No. Is it to Series 7, the company? Yes. When a company, look at me for a minute, I know you want to write down, I want you to listen to this. When a company issues the cumulative preferred stock, just by issuing it, they're saying, hey, I know we're declaring and paying you a 7% and that's guaranteed, but we could pay you less this quarter or this year. Just by issuing it, they're saying to you, because of its features, if it comes time for the distribution, if we don't have a sufficient level of earnings, we could pay you less. So you're only so far. Yeah. All of the types of preferred stocks are required to pay the full distribution in that quarter, in that year, except for this type of preferred stock. That's why it's issued more often than any other type of preferred stock, because it protects the company by saying to you, by issuing this type of preferred stock, when it comes time for the distribution, we don't have the sufficient level of earnings, we could pay you less. And until we do become profitable, whenever, at an undetermined point in time, could be 2 or 3 years from today, that's when we'll make up the rest that's past due in arrears to you. Are you with me so far? Yes. Sure. Watch this type of preferred stock. You go out and buy an IBM 4% preferred. That's $4 per share. Are you with me so far? Yes. Look at me. Here's your $4 per share. You are preferred stockholders. You got paid prior to common. Yes? Yes. And then the common stockholders got paid secondarily to you. Are you with me? Yes. And then I'm going to pay you, watch me, another 4% after common were paid per share. Why is this type of preferred stock called a participating preferred stock? Because you get 2 distributions. You get paid first because you have preference as preferred stockholders. Then common stockholders get paid, and then you participate with a second distribution in the excess dividend income lying in the company for a second payment after common were paid. Are you with me so far? Yes. You get paid twice. First, your preference, then common, and then you have an opportunity to participate with a second distribution of cash dividend income in the income lying in the company after the common stockholders were paid for a second distribution. Are you with me so far? Yes. So if you look more acutely at these 2 types of preferred stocks, they're all based upon a timing mechanism, which is when those dividends are actually paid to the preferred stockholder prior to the common, that distinguishes the cumulative preferred stock from the participating preferred stock. Are you with me so far? Yes. So that's what's similar about these 2 types of preferred stocks. It's the timing mechanism of when those dividends are paid. Are you with me so far? Yes. To the preferred stockholder prior to the common. Well, if they're similar in the timing mechanism of when those dividends are paid, are you with me so far? Yes. Well, then these 2 types of preferred stocks are completely dissimilar to the previous, because they have the callable and the convertible preferred stocks that we're going into right now have nothing to do with dividend income and when those dividends are paid, like the cumulative and participating preferred. When you go out and buy a security, I need you to really stay extremely focused on me. If you do, it'll be magnificent for you. And you buy a security that has a call feature that is attached to the security. How will you know? Well, securities that are executed to the tape, which we keep referring to, you might see IBM 109 PR with a little c. Are you with me so far? That means a round lot was executed at $109 a share of IBM callable preferred. Are you with me so far? Yeah. This little c means that these particular types of preferred stocks, are you with me so far, are called callable preferred stocks. Let me introduce this feature to you called the call feature. There are certain blocks of either bonds or preferred stocks that might be designated by the issuer, my example IBM is the issuer here, to be securities that are known as callable securities. Now the call feature gives the issuer the right, watch me now, to step into the marketplace on a certain date. This date built into the call feature of this security is called the date of call, or the call date. which gives the issuer the right, if they chose to call away, which is another way of saying buying back those securities from investors. And if the issuer decided to exercise their right to call away and buy back those preferred stocks from investors who are long those preferred stocks, you as investors would have no choice. You would have to liquidate and sell the preferred stock back to the issuer. And so it's rather inconvenient, are you with me so far? Yeah. That you would have to sell the security back to the issuer if they decided to call away from you. Are you with me so far? Yeah. You knew about that inconvenience. As a matter of fact, that inconvenience is expressed in the form of Series 7 call risk. What is call risk? It is the risk that the issuer might step into the marketplace. I didn't say would. I said they had the right to. Might step into the marketplace and buy back those securities from you, even when you didn't want to sell. Well, that's pretty inconvenient. Am I right? Yes. So why do you think an investor would take on that inconvenience of having to liquidate the security back to the investor when you didn't want to sell? Well, to induce investors to buy those securities and to offset the call risk of that inconvenience, the issuer is going to attach what is called a call premium Series 7 above the stock's face value that's payable to you on the date of call. Now, when you liquidate preferred, are you with me so far? Yes. You're always going to receive the face value of the security. Are you with me so far? Yes. Look at me. What is the face value of the dollar par value? How much is that worth for one share of preferred stock? $100. What happens if this security was a callable preferred security? And what happens if the call premium was $103 per share? If the issuer decided, in this particular case, to call away and buy back those securities from you on the date of call, even when you didn't want to sell, now you have to sell it back to the issuer. Instead of getting just $100 a share, you're going to get $103 per share. You see that additional $3 that I talked about above the stock's par value of $100? That's called a premium, a call premium that's payable to preferred stockholders for the inconvenience of having to sell the security back to the issuer because they decided to call away the securities from you. When you buy bonds, if they are callable bonds, always you want to receive the par value for one corporate or municipal bond, which is $1,000 per bond. That's how much is paid to you when the bond matures. But what happens if they were callable bonds? And what happens if the issuer decided to call away and buy back those bonds from you on the date of call, even when you didn't want to sell? Now you've got to sell the bonds back to the issuer prior to its maturity. And what happens if the call premium was $107 per bond? Instead of getting $1,000 per bond face value, which is what you would normally get, you would get $1,070 per bond. See that additional $70 that I just said above the bond's par value? That's the bond's premium price payable to you on the date of call for the inconvenience of having to sell the bond back to the issuer prior to its maturity. Now the question becomes, so you see the call feature has nothing to do with dividend distributions. Are you with me so far? Yes. It's rather a feature that gives the issuer the right to call away and buy back the securities from the investor, and to induce you to take on call risk, they'll pay you a call premium on the date of call. Now the question might become, if you're really thinking today, why would an issuer might want to buy back those securities from investors? Are you with me so far? Yes. Now that question is advanced, but I'll give you a quick answer that we'll go on to on a more elaborate basis when we get into week 3. For example, on the bond side, if they were callable bonds. An issuer might want to buy back old bonds if they can issue new bonds at lower interest rates, so that they can reduce their bond fixed interest expenses, restructure their bond portfolio, and engage in what is called debt restructuring and bond refunding, in a concept that you don't really have to worry about right now. Are you with me so far? Yeah. And so it's a little bit advanced for us, but if you're really thinking, you might want to wonder why an issuer might buy back those securities from the investors. And so all I want you to be aware of is what this feature gives the issuer the right to do, to step into the marketplace and call away and buy back those securities from the investor on the date of call, possibly to restructure their portfolios, which is exactly what you'll see when we get into the strategy of calling bonds away. Are you with me so far? Yes. And then, of course, to pay you a premium price called a call premium on the date of call for that inconvenience to induce you to buy it. Are you with me so far? Yes. So you might say as an investor, listen, if they did inconvenience me and buy back the security even when I didn't want to liquidate, at least if they do exercise their right to call away the security from me, they'll pay me a premium price for that inconvenience. And so we didn't say they would, but if they did, I would get a premium above the stock of the bond's face value. I'll buy the security. And of course, you're buying the preferred, even though it's a callable preferred, because why do you buy any type of preferred stock? Because of the... You've got to say it. Always. Remember, the #1 primary reason, regardless of any of the features of these different types of preferred stocks as to why you buy preferred, is because you want income. Are you with me so far? Why do you buy common? Potential capital gains. Why do you buy preferred? Guaranteed return. Are you with me so far? And to stay liquid in the stock market without locking your money up into the illiquidity of a bond maturity for a guaranteed 6% yield on the bond. Are you with me so far? Yes. So now these features start to make more sense when you understand how they're recommended and why and when. Are you with me so far? Yes. Right. That's why you can't beat this program. But in any case, I need a hit. Excuse me. I've been hitting these markets for 20 years. Forgive me. And it's a new one, so that means I'm out of control. Oh yeah, I had it delivered just now. Oh my God, I gotta get a life is what I gotta get. Well, the most exciting type of security is called a convertible security. You're gonna love this one because we're gonna trade it right now. And this security, watch my language, has a conversion feature that's built into the security that will give the investor the right, listen to me carefully, to convert only into common. Whether you're dealing with a convertible bond or a convertible preferred, you would have the right only to convert into common. So now you just found out why you can't have a convertible common stock. Because convertible securities are only converted into common. Are you with me so far? Yes. When would you have the right to convert that original security into common? Only on one date. What date? Conversion date. What happens if you, the investor, let that date come and go? Well, then you no longer have the right to convert. You stay long the original security. I introduced the conversion feature to you associated with convertible preferred stocks because we're talking about preferred. Are you with me so far? Why are you buying this convertible preferred? Because of the... Say it! Yes. You speak to me. I want to trade with you. Say it again. Yes. Yet, the broker might contact the client and say, here's why I want you to buy this convertible preferred. Mr. Johnson, you realize this convertible preferred has an 8% yield built into it. It's liquid, it's a stock, and earn 8% cash dividend on your money. And it's AA rated by Standard & Poor's on its liquidity and credit risk. And the other thing is this. As we approach conversion day, Mr. Johnson, if I believe that the performance of common stock is going to move in the market, are you with me so far? Yes. Based upon its expected earnings, then I might call you up a couple of days prior to conversion and get you ready to convert this preferred stock into common. And I'll tell you why. Because then if we have the opportunity, and I think we might, to convert that convertible preferred into common and end up owning common stock shares at a cheaper price than where I expect common stock to move in the marketplace, then I'm going to call you up to recommend conversion because then I can take the common stock portfolio after conversion and blow it out to the open market and show you a gain. And if common stock does not move up based upon my expectations, sit back, stay long your convertible preferred, and earn your 8% cash dividend on your money and stay liquid. You can't lose. I'm sorry, I got a little excited for you. Are you with me? Yes. That's how it's sold. God forbid you should get licensed. I should teach you how to open up accounts and trade. I will change your life. You have no idea. No idea. But then again, I am doing this for a quarter of a century. So, that opens up a whole Pandora's box about how to convert. When do we convert if we chose to convert? Conversion day. Why might we recommend conversion? Only if we get only shares of common after conversion at a cheaper price than the market price of that common stock portfolio. Are you with me so far? Yes. We'll establish whether we should convert and the value of ownership of those common stock shares after conversion on Friday when we get into the tax ramifications of convertible securities. All I want you to know about today is how to convert. Are you with me so far? Yes. The formula for conversion, there's no calculation on NASDAQ on this area. It's strictly conceptual now. Are you with me so far? Yes. I'll tell you when we get into mathematical computation, and it's not this week. Are you with me so far? Yes. Oh, it's coming, but not this week. Takes the par value, which is the dollar value for the original security. And the dollar value for one share of preferred stock is how much? There it is. I'm talking about one share here now, obviously. Are you with me so far? Yes. Because if I was talking about more than one share, it would be $100 times however many shares that we own. Am I right? Yes. Client owns one share of convertible preferred at a conversion price of 50. So you take the dollar value of how much the original security was worth, and you divide it by the conversion price. Now, market price of common trading in the market. It is not the market price of preferred stock trading in the market. It is the price at which you would convert if you decided to convert on conversion day, built into the conversion feature. Are you with me so far? I give you a conversion price of 50. Your client owns one share of convertible preferred. The conversion price is 50. It's conversion day. You as the financial advisor contact the client up and said, Mr. Johnson, let's convert. We'll end up owning common stock shares after conversion cheaper than the market price of those shares, and then we'll blow out that common stock to the open market and I'll show you a gain. It's time to make the move with me right now. He says, I'm done with you. Let's go. You convert. A division of two financial components yields a ratio. Are you with me so far? Yes. Is that ratio 2:1 or 2:4:1? I want you to speak financially accurate. Is it 2:1 or 2:4:1? It's 2:1. Are you with me so far? Yes. Thank you very much. You can give me the wrong answer. It's okay, because if you give me the right answer, I might fall over. And pick me up. Are you with me so far? Yes. We can make any mistake in this training program as long as we want to make this mistake on NASDAQ. So here, for each singular share of convertible preferred, At a conversion price of 50, your client's going to own 2 shares of common after conversion. Once he converts, he no longer owns the preferred. Are you with me so far? He now is long 2 shares of common. And so what we need to establish on Friday is whether you should recommend conversion. And I'll say it one more time. You'll only recommend conversion if he ends up owning those 2 shares at a cost per share that's cheaper than the market price of those shares per share. Because only then will you be able to take those 2 shares, blow them out to the open market, and show him a gain. Am I right? Yes. Therefore, if he does not end up owning those shares at a cheaper price than the market price of common, sit back, stay long, do not convert, and earn your 8% cash dividend yield on your money. Are you with me so far? Yes. You understand how it's sold? Are you with me so far? I'm going to ask you a question now, and if you lie to me, don't make me see you sweat, okay? Try to act like my 13-year-old who does a damn good job of it. Are you with me so far? Yes. Preteen, teen, or whatever there is, tween, whatever you call them. Do you know how to convert? Yes or no? Yes. You can't sit in abstention in my room. You've got to trade with me or you have to leave. Do you know how to convert? Yes. Really? I don't believe you. And that's something you should know about me. I'm never going to believe you until you walk through those doors with that goddamn stripe, and that's the 7. Are you with me so far? And so you believe me, you want me this way. So let's take a look and see if you lied to me or not. Your client owns, watch it now, 1 million shares of convertible preferred at a conversion price of 100. How many shares of common stock will this client receive on conversion day after conversion? Go. 500,000. Incorrect. 1 million. I got to have more than 2 answers in this room. You don't understand something. You're either going to trade with me or you're not. I gave it to you. I said the conversion price is 100. He owned 1 million shares of convertible preferred. At a conversion price of 100, how many shares of common will receive after conversion?
1 million.
100,000? Wrong. Don't know. And you told me you knew how to convert. You see, you lied to me again, but that's okay because I knew you didn't know how to convert because I looked right through your eyes and into your soul and I saw your answer. I didn't have any confidence in it because the question was loaded because you didn't have to calculate. Because when the par value for 1 share of preferred stock and the conversion price are the same, what's the ratio? It's an even exchange. He owns 1 million shares of common after conversion. You see, so that you didn't have to calculate. Because I could have told you he owned 20 million shares of convertible preferred at a conversion price of 100. We could receive 20 million shares of common. It's 1 for 1. Are you with me so far? Yes. 1 to 1. So now I'm going to ask you again one more time. Do you know how to convert? Yes or no? Yes. Guess what? I don't believe you, and I'm never going to believe you, and this is a good thing. And I'll just do 1,000 trades with you until you do, because I'm not going to move on until you do. Now, I want to show you how easy this transaction is. Your client owns 5,000 shares of convertible preferred at a conversion price of 20. How many shares are commonly received after conversion? Here's what you do, because I don't want you to make this into the mathematical calculation of the century, and you're on your way to doing that. The dollar par value for 1 share of preferred stock is $100. Am I right? Yes. The conversion price is 20. First thing you do is get the ratio. What's 100 divided by 20? 5. You said 5. That's mathematically incorrect. It's 5 to 1. This is a ratio. Are you with me so far? Yes. It's okay. I'm here to pick you up. So then what I want you to do is I want you to take the first number of the ratio, and I want you to multiply it times the original number of shares in the original preferred position. That's how many shares of common your client's going to receive after conversion, which is 25,000. Let's try it one more time because I still don't believe you. Your client owns 2,500 shares of convertible preferred at a conversion price of 10. What's the ratio? It's 10 to 1. Take 10. Multiply times the original number of shares in the original preferred position, and that's how many shares a common is going to receive after conversion, which is? 25,000. Do you know how to convert now, yes or no? Yes. I actually believe you. Are you with me so far? And that's pretty much a good thing. Once you get the ratio, take the first number of the ratio, multiply it times the original number of shares in the original preferred position, and that's how many shares of common your client receive after conversion. And of course, what we need to establish, and I can't impress it upon you enough, is the ownership of those shares to determine if it's worthy for you to recommend conversion, because you're only going to recommend conversion if he ends up owning those shares at a cost per share that's cheaper than the market price of those shares, to show him the potential capital gains as a result of the recommendation of conversion to the liquidation of common to the open market for trading profits. Yes, sir. And that number will never be a decimal, like the conversion price always. It's not a decimal, it's a ratio. It's the number of shares you're receiving of common for preferred. Right. But there's no way for it to be, like if the conversion price wasn't like... It's either going to be 2 to 1, 3 to 1, 4 to 1, 5 to 1. It's going to be an even number with respect on the ratio side, with respect to the conversion price. The conversion price is not going to be decimalized. Oh, okay. I know that's what you're worried about. No. Yeah. It's going to be a ratio. It's going to be an even number. Okay. Now, when you convert, you get... When you convert, you get it at the market price, or you Well, this is what we need to establish on Friday, and I would rather establish the price of the ownership of those shares in significant regulation to determine its worthy recommendation of conversion on Friday when we get into the tax ramifications of convertible securities. All I want you to know today is how to convert. I'll remain on Friday to answer the remaining questions as the price that we own those shares at after conversion, and we'll compare that and correlate it to the market price of the stock to determine if we should convert. Are you with me so far?
Yes.
And so, the callable and convertible preferreds have nothing to do with dividend distributions, unlike the cumulative and participating do, but rather features that give the issuer the right to call away and buy back securities and the right for the investor to convert into common. Are you with me so far?
Yes.
And this is mostly a prerequisite for NASDAQ. So we talk a little bit about the different types of equities that we have, and we're looking at their features in common and preferred. Remember, we're dealing with liquidity here. And now I want to talk to you about different classes of stocks. I say the word class, Series 7, you say the word industry. I say the word type, you think securities, common and preferred. The only two types of stocks we have. But when we talk about classes, we talk about the industries that we have. Class goes to industry. Now, I want to assure you from the bottom of my heart, this examination is not going to ask you the definition of a blue chip stock or the definition of a growth security. And by the way, the proper terminology for the security is the issue, or a growth issue, a blue chip issue, a defense or defensive issue, or a cyclical issue. Are you with me so far? Yes. Issue referring to the security, referring to the class, which goes to industry. No, they're not going to ask you the definition of a cyclical stock. You wouldn't need me for that. Believe me, you need me, but don't worry about it. I need you too. They have something grander planned for you. Series 7. I show you this examination well before you even get there. This is what they're going to do. What they're going to do is they're going to give you 4 industries. Biotech, healthcare, banking, technology. Are you with me so far?
Yes.
4 industries. And they're going to say, pick the industry that's indicative of a cyclical stock, or defense issue, or growth issue, or a large cap blue chip issue. Now watch this now. If you can pick the correct industry out of the 4 industry groups of A, B, C, and D that reflects the definition of the class, well, they're asking you the definition of the class without them actually asking you the definition of the class. Because if you know the correct industry that reflects the definition of the class, well, then you must know the definition of the class in order to select the correct industry. And that's classic example psychologically. Listen to me. Of NASDAQ, kind of asking you a question from the back forward. Are you with me so far? Instead of asking you the definition of a cyclical stock, pick the industry out of 4 industries that reflects a cyclical stock. You must therefore know the definition of a cyclical stock. So you got to watch the 7 because it's loaded with landmines, and I know where they are every step of the way. Are you with me so far?
Yes.
1 foot over the other. Right out with our license. It's a tightrope, but you got to stay with me. Are you with me?
Yes.
Okay, so what I've done, because I don't trust you, are you with me so far?
Yes.
And I'm never going to trust you. And you'll see when I get into weeks 2 and strategy week, I've even prepared notes for you because I don't even like how you take notes because I'm paranoid because I want everything to be perfect. Are you with me so far? Is I've isolated for all the classes of stocks, all the industries that you need to be aware of for NASDAQ. And so, with a little education behind each one, are you with me so far? It requires you to stay a little focused. And that is, when we talk about our blue chip stocks, blue chip securities, where does the word blue chip come from? Blue blood, which refers to what? Royalty. Are you with me so far?
Yes.
Right. When we refer to our blue chip issues, our royalty stocks, we're talking about the very best equities that we have in the market. Now that word best is very ambiguous. What do we mean by the word best? Well, when we mean the word best, we mean the most profitable companies that we have in the United States, if not the world. And when we measure the profitability of a company, are you with me so far?
Yes.
We look at the earnings, which means the profitability, over a 4-quarter year, and the consistency of those earnings, if they're unbroken. And therefore, that would be reflected in the payment of cash dividends to the common stock investors. What the hell does that mean? Didn't we just say that common stocks do not have guaranteed dividends? Am I right?
Yes.
What if I told you that this common stock is paying you guaranteed cash dividends when you buy it? In order for the common stock to pay you guaranteed cash dividends, it's got to mean the company is consistently profitable with unbroken earnings. Are you with me so far?
Yes.
That's what we mean by our blue chip stocks. Companies that are generating consistent levels of profitability over a 4-quarter year measured from 1 quarter to the next, paying you cash dividends, which you know are not guaranteed to the common stockholder, which means they're consistently profitable. That's what we refer to as our blue chip stocks. Are you with me so far?
Yes.
Or our royalty stocks, or the most profitable companies that we have in America, if not the world. And they are expressed not necessarily in the form of any one particular industry like all others, are you with me so far? But rather by one of the most prestigious indexes that you'll study a little bit later on today, expressed in the form of SIP, DJIA, Dow Jones 30 Industrials, which is that market that we talk about that's up 280 and down 170 from one day to the next. Are you with me so far?
Yes.
Those 30s, and we know some of them from Disney to IBM, and on and on and on, represent the most profitable companies that we have in the United States, if not the world. And when you see the qualifications that those companies have to meet just to qualify for Dow 30 status, you'll see why they are our blue chip stocks. Are you with me so far?
Yes. Yes.
Measured by an index, not necessarily an industry here. So the first is the exception to all. When we talk about income stocks, the income is the class, the industry series 7 is the public utility. And so when you buy Atlantic City Electric, New England Power and Light, Loco, are you with me so far?
Yes.
In that common stock, it usually pays a consistent cash dividend, which represents the income to the public utility common stockholder, and that's why it qualifies that industry as income in class. Are you with me so far?
Yes.
I want to talk to you about the drug called Eucipia for male pattern baldness. Oh, I don't really care. I'm not taking the drug. I'm not going to do any transplants. I'm just going to go through life with a smile like a raging bull bear and see what happens. But there are people that take Viagra, sure, you know, so that they can have a long-lasting, wonderful relationship. There are people that take Eucipia. And what about the oncology drugs of cisplatin and all of the cancer drugs that fight cancer by the Mercks of the world and the Squibbs of the world and the Pfizers of the world that produce these companies, these drug companies that produce these drugs and the oncology drugs that we have to fight various forms of cancer? These companies are called the pharmaceuticals. They are research and development oriented. Are you with me so far?
Yes.
Well, if you look at the balance sheet of Pfizer, are you with me so far in their annual report and financial section, you know what you're going to see? You look into the section called research and development, you're going to see a staggering number. Because most of these companies withhold their earnings in a section in the financial balance sheet called retained earnings, retaining onto their earnings, which are their profits, and moving that earnings picture into the R&D section to finance future oncology research. Are you with me so far?
Yes.
The biotech industries to finance that next drug line, oncology research cancer line. Are you with me so far?
Yes.
That's why these companies, known as the pharmaceuticals, are called growth companies or growth stocks. They're called growth stocks because they are not judged on their profit picture today, but their profit picture 3 to 5 years out based upon financing with their profitability that drug line that would generate revenue over a 5-year or a 7-year plan. Are you with me so far?
Yes.
A growth company is a Fortune 50, it's a Fortune 100, very profitable company at this end of the continuum of the business cycle whose sales and earnings and market share are outpacing competition. Are you with me so far?
Yes.
As opposed to, look at me, watch my body language, an emerging growth company. An emerging growth stock is a child. It's a baby. It's embryonic in nature. It's got no sales. It's got no earnings. It's coming into and emerging into industry. On the other end of the continuum of the business cycle, no sales, no earnings, no market share. It's a brand new baby. Are you with me so far?
Yes.
Growth company is a company who's outgrowing competition with respect to sales and earnings of a Fortune 50 status. And when we talk about growth stocks, we always go to the sector which is traditional in growth of the research and development oriented companies of the Mercks and the Squibbs and the Pfizers of the world that are R&D oriented. Are you with me so far? That's why they're called growth issues or growth stocks. And so the class is, of course, growth. The industry is R&D. Simple. When we talk about defense stocks, and I will teach you how to build a homeland portfolio for your client, buying energy stocks to hedge inflation. Are you with me so far? Because I'm going to take you to a level of sales you're not even going to believe you're going to master in 9 days. And you will have to build an energy portfolio for the clients to diversify their portfolio's risk and to hedge inflation. All homeland security stocks, all defense stocks, all energy stocks are known as defense issues. Are you with me so far? We're talking about defense stocks. Look at me. Defense. We talk about companies that are involved with the manufacture of goods and services for the defense of this great nation, which is representing an entire homeland portfolio that you'll be involved with for clients and all on the energy side as well with energy sector investments. Are you with me so far?
Yes.
And we use the company called Boeing and Lockheed and companies just like that that are involved as defense stocks. Are you with me so far? They're tied to military contracts that we talked a little bit about earlier, and they're also tied to their income, which is reflecting their industry. Are you with me so far?
Yes.
That will reflect whether or not a cash dividend will be paid on the stock and its performance in the market through trading. But I want to talk to you about something else, a different type of class. Defensive stocks. Now I want you to take a look at something right now. I need you to stay really focused today. Jose Rose is going to throw a punch at me right now, and I want him to do it. Don't actually hit me. You're a lot younger than me. Come on, I'm 50-something years old. But I want you to look like you're a southpaw?
No.
Okay, well, throw me a punch with your right hand. What am I doing? I'm defending myself. Are you with me so far? And that's similar to, and I'm a little far-reaching, I know, so forgive me, but I'm desperate for your education, the performance of how a defensive stock price moves in the market. A defensive stock reacts resistantly and defensively to its stock price decline. Well, why would that happen? And why are other issues not reacting defensively? What determines whether one stock will put up a resistance to its price decline defensively versus another that might lead the pack downward in price decline? Well, earnings. You got to listen to me. You got to listen to me today because I got just too much for you. It's almost like everything I say is so significantly impactful to everything else that we're going to be doing that you need to be right there on beat. You see, I never want you to forget that the most powerful financial concept that drives this entire stock market is earnings. Earnings drives the market. Don't ever forget it. Or lack of. One way or the other it's going. Are you with me so far? Yes. So if a stock puts up a defensive resistance to its price decline, are you with me so far? Yes. That means it's not going to go down much. I mean, it would go down marginally, an eighth, a sixteenth, or a quarter, when other stock prices would go down 2 5/8 or 3 1/4. Are you with me so far? Yes. And that must mean that this company, or companies that react like this, defensively, putting up a resistance to its stock price decline, must be consistently profitable. Because if they're consistently profitable, that strong earnings picture, regardless of the state of economic affair, are you with me so far? Yes. Is allowing that company's stock price to react defensively. Am I right? Yes. Because the earnings is allowing a certain level of stock price support so that if it did go down, it will go down marginally at best. Now look, regardless of what I've just said, nothing will save a stock's price from getting crushed if it experiences systematic risk. Now, what is systematic risk? It is the risk that if that index is going down within which that stock trades, it's like skating on ice. Everything is going down. I don't care how strong the earnings of that company is. It's not going to save that stock's price. You with me so far? Yeah. It's like a current. You know, we buy trucks, and then we go out there on ice, and we got 4x4s that are the size of this goddamn conference table. But if you're skating on ice, I don't care what you're driving, you're going to skate. Are you with me so far? Yes. And so that's similar to the systematic risk that I'm referring to. But now we're talking about companies that are American defensive stocks. And I got to tell you why. Because I am telling you that these stocks in America, American defensive stocks, are always consistently profitable regardless of the state of economic affair. That must mean that these companies are providing goods and services to the U.S. economy that we will continue to pay for regardless of the inelasticity of demand. You need to listen to me today. Let me give you an example of what I mean by American defensive stocks. Do you really believe that if you and I lived in the land down under, where's that? Australia. That's right. And we were not just Australians, we were Aborigines living in a goddamn tribe. Are you with me so far? Do you really need candy to live? You really need, bang, good old Miller High Life? You think we need tobacco in order to function? No. We have a different culture. That's why I qualify them with the prerequisite and prefaces as American defensive stocks. Because only in America do we believe in more than $40 billion tobacco, candy, and beer, and food and power and light, which are the industries that are indicative of defensive stocks, are providing goods and services that we continue to pay for, regardless of their costs. Are you with me so far? Yes. In order to survive and function. That's why we qualify and get an indication of the American culture, which I'm sure we pretty much know. For example, I went to buy a pack of cigarettes this morning. Are you with me so far? Yes. I like to buy it out of state because it's cheaper. Are you with me so far? Yes. So I forgot, I haven't bought it in New York in a while. I says, okay, a pack of Marlboro, how much is that? He goes, $11.90. I said, what the hell did you say to me? I said, what did you say to me? And as I'm screaming at him, what am I doing? I'm counting off $12 and I'm giving it to him. You know, in 1973, I had hair. I had a convertible. What happened to my life? Well, it's much more fruitful now with the children and the wife and all that, I want to assure you. But I had hair and I had a convertible car, and it was 1973 when you were barely having a peanut butter and jelly sandwich in grammar school. And I was on a gas line for about an hour waiting to gas up when gas was $40 a barrel. Are you with me so far? Yes. We didn't have hybrid cars then, by the way. So what was I going to say? When gas goes to $5 a gallon, what are you going to say? I'm going solar. I'm not paying this, really. How are you going to get around? Taking buses and driving bikes? You know, regardless of the cost at the pump, there are certain services and products that we will continue to pay for, regardless of the inelasticity of demand, regardless of the level of inflation, in order to stay alive. Are you with me so far? That we consider. If they increase the tolls over the bridges, if they increase the cost of the Metro card in order to get around, what are you going to say? I'm not paying that. Okay, you walk because I'm taking the train. There's no choice relative to the cost of the rising prices of what we believe are goods and services that we will continue to pay for regardless of inflation. Are you with me so far? Yes. And that's why these industries, tobacco, candy, beer, and food, and power and light, Series 7, especially the rising cost of food, are you with me so far? Yes. Are known as defensive stocks because they're always profitable, providing to the economy products and services that we will continue to pay for regardless of their costs. And that high profit picture will allow them to maintain a certain level of stock price support so that if they did go down, they would react more defensively than other issues who might lead the pack down during economic downturns. Are you with me so far? Yes. Unless, of course, they've experienced a certain level of systematic risk. And regardless of their profitability, nothing is going to save the slide. Are you with me so far? Yes. When we look at cyclical stocks, the industry is cyclicality. Are you with me so far? The industry is steel, Series 7, cement, and machine tool and die companies, and automobile stocks. And those are the industries that are indicative of cyclical stocks. How does a cyclical stock work and move in the market? As a mirror image with economic activity. What do I mean? During economic prosperity, which is hopefully where we're trying to move to. Are you with me so far? Yes. You see a lot of increased new housing, construction, and all the economic of leading and lagging and coincidental economic indicators that you studied with respect to the Federal Reserve that will cover later on are rising and showing us and giving us an indication of economic prosperity. We have the credit markets that are unfrozen during economic prosperity. We have a lot of borrowing going on, movement of liquidity into the marketplace, everything that we're not experiencing right now. Are you with me so far? And therefore, and as a result, we're going to buy cars then. Are you with me so far? And the orders for the machine, tool, die, and automobile companies, their orders are up during periods of economic expansion and prosperity. Their sales are up, their earnings are up, their stock prices rise, are now buying in the marketplace, reacting as a mirror image with economic upturns. And during periods of economic recession, are you with me so far? Yes. New administration, new president, and economic uncertainty along with political and military uncertainty in the overall global economies, which is what we're experiencing right now, trying to come out with a federal bailout and TARP money of a recessionary period of time based upon the collapse of the real estate market, which has affected the equity market, which has affected job loss, which has affected disposable income, which has affected the liquidity of the amount of money that's being lent out there, as we're all tied to. Are you with me so far? Yes. That was a summation in less than 30 seconds of basically what's going on out there. Are you with me so far? Yes. That we'll get into on a more elaborate basis that I keep touching on to kind of make you really understand the complexity of these markets and how they're intertwined. I mean, the last thing that's happening is that the orders for steel and cement and machine tool die companies are up. They're down. We're not buying cars right now. Automobile industry is consolidating and going out of business with federal money, and therefore, and as a result, these stock prices are reacting as a result of that negative sales picture down on that massive sell-off in the market. What is a cyclical stock? It is a stock that reacts cyclically with the economy. It's a direct mirror image to economic activity. Economy is prospering, stock prices are rising based upon positive sales and earnings, and stock prices going down during a floundering economic activity marketplace. Are you with me so far? Yes. We're talking about seasonal stocks. Are you with me so far? Yes. Seasonal is the, of course, class. The industry is, of course, retail. And they act seasonally during certain periods of time of the season of the year, where their sales are usually up. Are you with me so far? Yes. During the periods of time of the holidays and back to school. Are you with me so far? Yes. Have any idea how much it costs to put 2 children in a grammar school or middle school level back to school the first day of the first week of September? Costs about $1,100 between the jeans and the backpacks and the supplies that are now being more passed through to the parents as a result of the lack of funding that school systems have. Are you with me so far? Yes. Very expensive just to get started. Are you with me so far? I'm not talking about going to Neiman Marcus and Nordstrom's. I'm talking about JCPenney of a discounted level just to get them in that school. And so we deal with certain periods of the economy, or periods of time of the year, that usually have performed well for certain retail stocks. So you're with me so far in retail companies, and I think the outlook is bliss with respect to the disposable income because of what we've said, the job loss that has affected the consumer spending and the disposable income out there in the economy. But usually the holidays and back to school, the sales are up and earnings are up, and they stock price perform well during those periods of economic seasonality. Are you with me so far? Yes. Just on a personal note that you should know, because it's periods of time of the year are coming now. During the holidays, we talk about America and we start to take a look a little bit closer at the waste, the way we live, and we're moving now more into, I think, a European mentality of hybrid cars and become a little bit more consolidated in our approach. And I don't want more cheese on those fries. And no, I don't want an excursion because it costs me $100 a week to gas up. And no, I don't want to talk on the car while I'm driving, get into an accident. I want to live a more compliant and conservative life because we're scared right now. Are you with me so far? And we should be. I want you to know that of all those holidays in the United States, there is one holiday that is the highest grossing revenue holiday that has outpaced Christmas and New Year's 2-to-1 over the last 4 years. So you can eliminate Christmas and New Year's right there. Give you an idea, and I say this to you as an indication of the American culture. Which holiday is the most profitable holiday in the United States? Cannot hear you. No, sir. No, sir. No, sir. Valentine's Day is a good guess. No, sir. Mother's Day we heard. Valentine's Day we heard. No idea. New Year's, I said you can eliminate Christmas and New Year's because this particular holiday has outpaced Christmas and New Year's 2-to-1 over the last 4 years. Not Easter, it's another good guess. Not 4th of July, Halloween. Halloween. The ghosts and goblins are Freddy, Jason, and Michael Myers in Halloween, and the memorabilia associated with candy sales and all Halloween-related memorabilia has outpaced. I got a neighbor. I got to tell you this because I can't get over this stuff. It's the week of Halloween. You know, it's a big thing when you got little kids. And I really didn't realize that when I had kids right away, that I got to take off that day to go trick-or-treating with the kids because they cried and said, Daddy wasn't here. I mean, it's like a big thing, you know what I mean? I got to tell you. Forgive me. But yeah, I do. It's a big thing to go trick-or-treating with the kids. I forgot how great it was when I was a kid because we did it in the tenement kind of thing because I'm from the streets. But, you know, when you're out in the burbs, you go from house to house. You know, I got a neighbor, I hear this. Boom! But neighbor's building a coffin on his lawn with 6 skeletons. And people are a little bit out of control with this thing, you know. How you doing there, Tony? Boom! I says, how are those skeletons coming along, Bob? Well, we're doing just fine. By slamming, you know, Dracula into the foyer of the house. I mean, people are insane. Jesus Christ! Halloween. Just thought you'd like to know. You know what I bet you thought? I bet you thought that we predominantly, almost exclusively trade American stocks here in the United States. Couldn't be the furthest things from the truth. You know, billions of dollars of foreign stocks are traded here in the United States. Billions of dollars of Asian internet stocks and European stocks. Are you with me so far? Yes. Now, I want to give you the name of a stock that I want you to look at when you go home tonight in the financial section. Go to the over-the-counter market and take a look at this particular company called GlaxoSmithKline, symbol GLXO. 4 symbols, NASDAQ. Didn't we say that? Yes. GLXO. Let me tell you something about this company. This is really fascinating when you think about what really happened. You know, there is a commercial, there used to be a commercial by an industrial plastics manufacturing American company that was run that I used to be amazed at. I love commercials, and I love the news, and I love sports, and everything else after that you can throw under the bus when it comes to me. But that's just me. This company ran this commercial that used to put me with my mouth open like in shock and awe. We're the company that built the infrastructure of the house you're living in right now. We're the company that makes the plastics that are in the carpet that you're lying on right now. We're the company, and I used to go to my wife like this, hey, honey, you got to come over, you got to take a look at this commercial. Just about everything we have in this house is made by this company. I mean, you know, from one origination to the other, I mean, I just couldn't believe. I said, honey, you realize on this coffee pot, they make the plastic that's in the fusion that's in this pot. Do you believe this company? It was like a crazy thing. I couldn't believe it. Yeah, they make that. They make that. I was like, no. And that company was SmithKline Beecham. We're SmithKline Beecham, an American industrial powerhouse plastic giant. Are you with me so far? I think they're into everything that we touch and live with. It was just a fascinating commercial to me. And one day, a company came along, and this company was Glaxo Wellcome. And they went through a name change. The original name of the company was Glaxo Wellcome. They changed to Glaxo Holdings. Are you with me so far? Yeah. And Glaxo comes along, that's why it's called GLXO, Glaxo Holdings, and buys SmithKline Beecham. And so now the new name of the company is called GlaxoSmithKline. But when you look in the paper for this company and you see its stock price, you're going to see these 3 little words, ADR. Stands for American Depository Receipts. You want to know why? Because Glaxo is the British Squibb of London. It's a British pharmaceutical. I'm telling you that the British pharmaceutical comes along and buys the American industrial giant. Are you with me so far? Yeah. This is a foreign stock. It's a British stock. Are you with me so far? Yeah. We sell British stocks. We trade German issues. We trade Asian internet stocks. Are you with me so far? We're trading foreign issues from all over the world, right here. They are called American Depository Receipts, these foreign stocks. That's their proper name, because the actual physical shares of GlaxoSmithKline or that Asian internet stock, the actual physical shares, they're not held here in the United States. The question now becomes, where are the actual physical shares held? They're held Series 7 Bullet 1 in U.S. banks in Beijing, or in U.S. banks in Dusseldorf, Germany, or in U.S. banks in London. Are you with me so far? That's where the actual physical stock shares are located. Now, if the actual physical shares are located in U.S. banks abroad, and we're trading these foreign stocks, where? Here on the NASDAQ, like I said, in the over-the-counter market, well, then that would mean that if the physical shares are held in U.S. banks abroad, an investor who buys these foreign stocks would not be able to take physical possession of the physical stock certificates if he chose to, because the actual physical shares are not held here. Are you with me so far? So what we needed to do here in the United States, please look at me, was come up with a document, a receipt. I'm showing you a receipt, just like the receipt that you get when you purchase anything. Are you with me so far? This receipt, please look at me carefully, is deposited here in America. And that receipt is the only representation and documentation that we have that represents a claim for the investor to actually buying and selling and trading that foreign stock whose shares are actually held in U.S. banks abroad, because the physical shares are not here. That's why we needed this substitution document. Are you with me so far? So why are foreign equities called American Depository Receipts? Because that receipt, which is deposited here in America to the investor who buys those foreign stocks, represents an opportunity that would allow him to facilitate the trading of those foreign shares, whose shares are actually held in U.S. banks abroad. And what should happen if GlaxoSmithKline or any other foreign equity should declare and pay a cash dividend to the investor? Are you with me so far? Yes. Will they be paid in the euro or the pound sterling, or will they be paid in U.S. dollars? Well, if the stock is traded here in the United States on NASDAQ, that dividend that foreign stock is paying has to be paid in U.S. dollars. And so what I want you to be aware of are 3 fine points regarding American Depository Receipts. And here they come at you right now. 7. The American Depository Receipt, Series 7 Bullet 1, by definition, is a document or a receipt that facilitates the trading of foreign shares in the United States. That's its definition. That's what I want you to know. It's a receipt that's deposited in America that facilitates the trading of foreign shares here in the United States. For without that document, we wouldn't be able to trade the foreign stock. It's a receipt deposited in America that it's actually facilitating the trading of foreign stocks. Its definition. Series 7 Bullet 2, where are the shares? Because they're going to ask you, the shares are held in U.S. banks abroad. And Series 7 Bullet 3, if the stocks are paid a cash dividend, it's paid in U.S. dollars. Are you with me so far? Yeah. Now, we started out with cash and or stock dividends today. And so I'm going to wrap up this segment right now with cash dividends. Are you with me so far? Yes. But I want you to listen to me. I'm going to trade with you now. So I want to know if you're ready to trade with me. Yes or no? Yes. Thank you. I want your eyes right here on this board.